From Bitcoin printing a fresh all-time high, only to follow it through with one of the most violent liquidation events in crypto history, from double tops at the highs to midweek retracements to Friday's brutal wipeout, there's been no shortage of lessons to take away. In today's video, I'm going to walk you through each day's price action using the TBD system, breaking down where the structure was clean, where the traps showed up, and what this all means for the levels we're watching heading into next week. Along the way, we'll also touch on some insights shared by Pedro, Jarrid, and Annii that give even more perspective on what just unfolded. Hi, my name is Janet. This is Trade Travel Chill. If you're new here, welcome. If you're returning, welcome back. Be sure to hit the like and subscribe button so you can be notified every time I upload a new video. With that being said, let's get into it. I want to quickly go over what happened the week prior on the run up to the all-time high. We've talked about this price action here, but we had the 3-level drop. Price then went into the trapping volume formation. And if you did not get the entry within the trapping volume formation, then the next entry is to wait for a breakout and a retest of the EMAs. You can see that we did come back to retest the EMAs on Tuesday during that week, and then price flew from there. But what's even more interesting, and many of our members picked up on this, is price action then went into the 33 trade. So what will happen with our 33 trade is price will give you the reversal pattern. This could be your W, your M formation, trapping volume, half Batman, something, but you'll get a reversal pattern. When it comes to rise level 1, everything proceeds as normal. We want volume through the EMAs. We want a break of the center peak of a W formation, but it's what happens after the rise level. Price will go into consolidation near a key level. This could be the high of the day, the initial high of the day, the high of the week. But price will go into consolidation before going into the rise level 2. Consolidation again, rise level 3. If you can identify that we are in a 33 trade, then the entries become much easier because you know that you are looking for an entry within the consolidation instead of waiting for a retrace. And if you miss the entry through here, then you know what you're looking for when it comes to the next entry. You also know what happens once the 33 trade is done. So the entry that happened after the trapping volume formation was also the entry within the consolidation between levels. From there, we see a breakout into rise level 2 for the 1 hour time frame, the rise level 3, and this part here as the extension. The key thing with the 33 trade is consolidation between levels, not retraces. Coming into Monday, Bitcoin was still riding the momentum from last week's breakout. On the 1 hour time frame, we just had the clean 33 trade that gave us a new all-time high, but only just. The move carried over into the US session on Monday, where we saw a double top at the fresh all-time high. That double top was the first clue that momentum might start to shift. Whenever we see price stall like this right after an all-time high, it's a sign the market could be setting up for a change in structure. Now, while that was unfolding, there were a couple of key things happening in the background. Pedro released a breakdown on how government shutdowns have historically played out. The last one took place in a bear market, whereas this one is different. It's happening in a bull market, which changes the dynamic. He also highlighted October as ETF month, but warned that with the shutdown, there may be delays. On top of that, Pedro pointed to Charles Hoskinson's interview, where he argued that privacy and blockchain utility will define the next 3 to 5 years. That broader context ties in neatly with Jarrid's blog this week. He broke down Kim Carson's framework on how liquidity and reflexivity drive markets. The first point Jarrid drew out was about valuations. Just because the markets feel expensive doesn't mean they're about to collapse. Valuations are risk, not timing. Like an airplane flying at 60,000 feet. You can stay up there as long as there's fuel, and in markets, that fuel is liquidity. The danger only comes when liquidity dries up. From there, he connected it to lessons from the dot-com bubble. Bubbles aren't irrational mistakes. They're natural outcomes when liquidity, leverage, and strong narratives collide. Back then, it was the internet. Today, it's AI, structured products, and government liquidity keeping markets afloat. He also emphasised how structured products and passive flows create a feedback loop. These products suppress volatility, which makes markets look stable, which then encourages even more demand. It's a cycle that mechanically pushes prices higher until something breaks it. Policy and liquidity play a role too. In the late 90s, Greenspan loosened policy and fueled the bubble. Today, governments are even more aggressive, willing to push liquidity despite inflation risk, especially heading into elections. That's why Carson sees today as a repeat of the late 90s, only with bigger deficits and more fragile fundamentals. Then there's reflexivity. When everyone's positioned the same way, the flows themselves drive exaggerated outcomes. Hedging, re-hedging, and leverage amplify both rallies and corrections. That's why markets can seem to grind higher endlessly, then unravel faster than anyone expects. He also pointed to the explosion of non-correlated assets since 2022. Hedge funds, structured products, gold, and of course, crypto. They've all ballooned as alternatives to the old 60-40 portfolio, and as they grow, they become drivers of liquidity in their own right. The key takeaway Jarrid shared: liquidity is the real engine. Rising markets create more collateral, which fuels more leverage, which drives more buying. It's self-sustaining until inflation forces central banks to tighten. Inflation is the check on unlimited liquidity, and it's why debasement trades like gold and crypto continue to thrive. So on Monday, while BTC's double top was hinting at a technical shift, the bigger narrative was also clear. Liquidity is still the driver. The bubble can go higher, but the risk are mounting. That's why the levels we're trading right now matter so much, because they're not just about numbers on a chart, they're where technical setup meet global liquidity forces. Come Tuesday, we started to see a real shift in market structure. On the 1 hour time frame, shorts began to step in, with a couple of positions even called out in real time, giving everyone the opportunity to catch an entry for drop level 1. This is the setup that I put out on BTC, and this here is the all-time high. The setup I was looking for was a retest of 50% Asia with a stop loss above the initial high of the day. So if I drop down to the 15-minute time frame and measure out where 50% Asia was, you can see we did get a bearish retest of 50% Asia and price hovered around that area. And if your stop loss had been in the right place above the initial high of the day, which is where my stop loss is on the chart that I shared, then you would have been safe from the US session open manipulation. And that gave everyone the entry for what would become drop level 1 for the 1 hour time frame. The key confirmation was the break of the 50 EMA and the center peak of the M formation. At the same time, it's important to keep in mind that the 33 trade from the previous week is still in progress, and the target for that trade is the 200 EMA on the time frame that you can identify the 33 trade. So in this case, it's the 1 hour time frame, 200 EMA. As long as that target hasn't been hit, we frame the drop within that context. So for now, Tuesday was all about recognizing the change in structure early, aligning with the break of the EMA, and letting the 200 EMA guide the downside target. If you need an exchange to trade on, consider checking out WEEX. It is one of the few exchanges that held up through this major liquidation event. It has a clean and simple layout and built for traders who want to focus on the actual trade without being distracted by a messy platform. Execution is fast and the interface is smooth. And here's the best part. By using the link in the description below, you'll automatically unlock VIP2 trading level, which is the equivalent of a 25% discount on your trading fee. That's a pretty big edge if you're trading consistently, because it means more of your profits stay in your account. So if you haven't already, click the link below, check out WEEX and give it a try for your futures trading. On Wednesday, the momentum started to shift back in the opposite direction. Dropping down to the 15-minute time frame, we got a clean multi-session, multi-day W formation rolling out of US into Asia. Through the UK session, we see volume through the 50 EMA, a break of the center peak of that W, and a break of the initial high of the day. This gave us a rise level 1 on the 15-minute time frame. At the start of the US session, we got our typical session open volatility. The volatility provided a retest once again of 50% Asia, before continuing the move to the upside for a rise level 2. Now sometimes the model doesn't give us all 3 rise levels, especially when it's feeding into multiple time frames. In this case, those intraday rises were part of a larger retracement feeding into the higher time frame structure that we've been tracking. Overlaying that technical picture, Pedro also released a breakdown that tied into what we were seeing. He highlighted how OG wallets are still accumulating Bitcoin, even in the face of volatility, and mentioned that a pullback to around 117k would be completely normal in the context of this trend. He also pointed out that early October tends to act as a correction period, which lines up well with the information that's been developing since the all-time high. The one caveat: nobody could have predicted the sheer scale of liquidation event we'd just seen. That shock move rattled the market, but Pedro's point still stands. Longer term flows are buying dips, even as short-term traders get shaken out. So Wednesday gave us clear technical confirmation. A W on the 15-minute, volume pushing through the 50 EMA, and a clean retest of 50% Asia before continuation. Thursday was one of those days where the lower time frames gave us a lot of chop and whiplash. We saw moves both ways without a clear trend. But the bigger takeaway was that this was the point where the 33 trade on the 1 hour time frame finally completed. So if we go out to the 1 hour, at the start of this video I mentioned that the 33 trade is not yet complete until price either retraces back into the 200 EMA or we go into an extended period of consolidation and the 200 EMA catches up with price. So on Thursday we finally hit the 200 EMA on the 1 hour time frame. That completion meant the trade we had been tracking from earlier in the week had run its full course. From here it's basically a reset. The market could either consolidate and build fresh setups off the EMAs before continuation, or break down further and retest deeper levels. During the UK session, we've seen a run to the upside before US session completely took it back before closing back into this range. It was a reminder that not every day is pressing for entry. Thursday was about recognizing the completion of the higher time frame move and waiting for the next clean structure to form. Friday really showed us why it's called Trap Move Friday. Asia set the range for the day. This is typical sideways consolidation between 1 to 2%. UK session stayed within Asia's range, tightening that range even further. By the time US session opened, it looked like a typical setup. We even saw the familiar open manipulation that usually leads into continuation. Instead, it triggered one of the biggest liquidation events crypto has ever seen. Now, was there a way to get an entry on this move before it happened? And yes, there was. If you've been watching this channel for a while, you'll know that we talk about sideways consolidation a lot because we're always talking about the weekend trap, and when Annii does her updates, it's usually on a Sunday whilst we are still in consolidation over the weekend. So you'll be familiar with what I'm about to tell you now. When price is in consolidation, a good way to preempt what is going to happen next is by reading the open interest and the volume. If the volume is flat and open interest is flat whilst price is in consolidation, this means that no one is really opening positions and market maker needs to drive price out to induce traders to take a position before they can make the next move. So to break it down simply, if price is in consolidation, open interest is decreasing or flat and volume is flat, this means stop hunt likely before a major move is made. So if you were looking to take a position on Friday, this would have been your entry at the start of the US session, identified as the stop hunt before the next move. Just within the US session alone, price dropped nearly 8%, and then we had the fast move down as soon as the market closed, making the total drop for that day 17%, wiping out weeks of positioning. And as brutal as that was, the altcoin market suffered even worse. We had XRP drop 58% in one day, Solana down 40% for the week. Some revisited 2020 lows, some printed fresh all-time lows, and others fell as much as 80% in a single session. Our cabin crew jumped on an impromptu Zoom session, not to chart setup, because what can you really do in a move like this? But to simply be there for people, to calm the panic, talk through the emotions, and just listen to anyone who was struggling. Because as great as it is for the model to play out and give us 3 clean drops, no one could have predicted that it would happen this fast. Yes, we've always had the 104, 107k liquidity range marked, and we knew it was a possibility, but honestly, who cares about being right when so many people were caught in the move? Well, that's how I feel about it anyway. And that's the risk we all take in this game. but it doesn't make it any less tough to watch members of the community get hurt by something like this. And on Bitcoin, it doesn't even seem that bad, but when you look at those altcoins, they got annihilated. So by the end of this big move, we knew that the liquidity sitting around 104 to 107k had been cleared out. But we've also built up fresh liquidity between 90k to 95k. The big question now is whether BTC can form higher lows on the 4-hour time frame and start to give us that change in market structure to push for a new all-time high, or whether we form a lower high on the daily time frame and roll over into the lower liquidity. So Friday was a hard reminder that no matter how good the model is, discipline and protection always come first, because nobody can predict the exact speed and violence of a wipeout like that. SilverWolf put out 2 powerful blogs that dug into exactly why the crash happened. In his first blog, he called October the 10th a day that will go down in financial history. A perfect storm of Trump's tariff bombshell, the rare earth metals conflict, and extreme hidden leverage that had been quietly building across the market. He explained how the crash wasn't just emotional panic, it was mechanical deleveraging. The yen carry trade unwind, cross-margin tangent, and algorithmic liquidation engines all fired at once. That's why the drop was so violent. Collateral disappeared, forced selling cascaded across assets, and thin liquidity in altcoins amplified the crash to levels worse than COVID, FTX, or 2018. But SilverWolf also highlighted the reset effect. As brutal as it was, this kind of leverage flush clears the system and creates healthier conditions for the next leg. It doesn't mean the bull market is over, it means the road ahead will be more volatile, shaped by tariffs, inflation, and liquidity flows. In his second blog, he pulled back the curtain on the mystery whale behind the crash, Jarrid, known on X as Jarrid Bullish. Jarrid placed a 1.1 billion short position just 1 minute before Trump's 100% tariff announcement. That trade netted him close to 200 million in profit and raised serious questions about insider information. His past is riddled with exchange scandals, and whether he was hedging legitimately or exploiting foreknowledge, the fact remains one trader's bet rattled the entire crypto market. It was a stark reminder of how fragile liquidity really is. Then on Sunday, Annii dropped a video that was exactly what the community needed after such a brutal week. She broke down her thoughts on trading post-liquidation, focusing on BTC rather than chasing altcoins. Her message was clear. The all-time high behavior we just saw looked more like trapped traders than true strength. And when Annii rants, you know it's worth listening to. She explained one of her key risk practices. Once a trade is deep in profit, she increases leverage to free up margin, either to protect capital or to redeploy it somewhere else. It's a smart way to avoid overexposing capital on exchange while still riding a winning trade. The weekend then wasn't just about consolidation on the chart, it was about consolidation in mindset. SilverWolf exposed the structural fragilities behind the crash. Jarrid's trade reminded us how one actor can move the whole system, and Annii grounded the community with practical lessons on how to protect capital moving forward. For us as traders, the lesson isn't just about spotting the setup, it's about protecting capital, managing emotions, and leaning on community when things get volatile. That's what kept so many of us grounded during Friday's chaos. And honestly, this is where having a community becomes priceless, because imagine being on the wrong side of that move and you're trading alone. No one really understands the emotional hit like other traders do. If you want to take your trading deeper and be part of a group that trades one system, one language, and supports each other through weeks like this, consider joining us over at Trade Travel Chill. We have 2 memberships to choose from, business class and first class. You'll get access to the live calls, community chats, and full breakdown of the system we use here every week. So be sure to check out the link in the description below if this is something that interests you. And make sure to stay tuned for Annie's upcoming video, where she'll be sharing her take on this week's price action and where we might be headed to next week. You definitely don't want to miss this one.